What if I told you that one narrow strip of water, barely 33 kilometers wide at its tightest point, just sent the entire global economy into a tailspin? That's not an exaggeration. That's February 28, 2026. Here's what went down. US-Israel strikes on Iran triggered a chain reaction that nobody who runs a factory, fills up a gas tank, or pays an electricity bill could ignore. By early March 2026, the Strait of Hormuz, a narrow waterway sitting between Iran and Oman, was effectively shut. And this isn't just some regional shipping lane. This is the world's most critical energy highway. Every single day, roughly 20% of all the planet's oil and LNG. That's liquefied natural gas. Basically natural gas that's been supercooled into liquid form so you can ship it on tankers. Flows through this one choke point, 1/5 of global energy supply. Through a gap you could drive across in under an hour. So when that closes, think of it like a heart attack for global trade. The main artery carrying 1/5 of the world's energy gets blocked, and the whole body goes into shock almost immediately. And the markets made that crystal clear, fast. Oil prices surged 36% in the very first week of March 2026. The single largest weekly jump since crude oil futures began trading back in 1983. That's over 4 decades of market history and nothing. Not Gulf Wars, not financial crises, not pandemics. Hit this hard this fast. But it didn't stop there. Qatar, one of the world's biggest LNG exporters, halted production at its Ras Laffan facility almost simultaneously, instantly wiping out another 20% of global supercooled gas supply on top of everything else. Countries that depend on that gas for their factories, their power grids, their heating, they suddenly found themselves in a desperate bidding war just to keep the lights on. JP Morgan's latest estimates put the potential loss at 9 million barrels of oil per day if the strait stays closed through end March. That's roughly 10% of everything the entire planet consumes daily. Gone. This isn't a temporary price blip that settles down in a week. This is a structural shock to the global energy system, and its ripple effects are already reshaping costs, supply chains, and business decisions on every continent. So that's the what and the why. But here's the question that actually matters for your money, your business, your economy. Who takes the hit, and is there anyone quietly winning from all this chaos? That's exactly what we're getting into next. Now here's the thing about a crisis of this scale. It doesn't hurt everyone equally. Some players are quietly celebrating right now. Others are getting absolutely crushed. Let's break down which camp is which. Start with the winners. And keep an eye on that rising trend line on screen, because this tells the whole story. US shale producers like ExxonMobil and Chevron, they are having a genuinely spectacular week. WTI, that's West Texas Intermediate, the benchmark price for American crude, just surged 36% in a single week. Think about what that means for a company pumping millions of barrels a day. Every single barrel is suddenly worth dramatically more. Their margins are exploding, their stock is climbing, and frankly, they didn't have to do anything except already be in the right business. Canada and Australia are riding the same wave. Both diversified energy exporters who can now command premium prices for their LNG as desperate buyers scramble for alternatives. And then there's the quieter winner nobody's talking about enough. Renewable energy companies like First Solar and Siemens Energy. When fossil fuel prices spike this hard, the business case for solar and wind basically writes itself. Expect serious investment to flow into alternative energy infrastructure off the back of this. Now flip the coin, because the losers list is where it probably gets personal for you. Oil importing Asian economies, India, Thailand, the Philippines, are staring down a brutal trio: soaring fuel costs, rising inflation across the board, and widening trade deficits, meaning they're spending a whole lot more on imports than they're earning from exports. If you run a logistics, manufacturing, or food business in any of those markets, your input costs are already moving against you. Industrial manufacturers are getting hit even harder. Aluminum smelters, fertilizer plants. Some are literally invoking force majeure right now, which is the legal equivalent of saying circumstances beyond our control, we're pausing the contract. They simply cannot source enough gas to keep the lights on. So here's your practical takeaway. If your supply chain touches anything energy intensive, freight, chemicals, food processing, plastics, brace for cost pressure through March and beyond. This is the moment to audit your supplier contracts, lock in prices where you still can, and get brutally honest about which costs you can pass on to customers and which ones you're going to have to absorb yourself. So now you know who's winning and who's bleeding. But the bigger question is, how long does this actually last? And what does the endgame look like? That's exactly what we're getting into next. Follow us for more updates like this. Thanks for watching. And don't forget to follow us on YouTube, Instagram, and X.